Well, good evening and welcome to another edition of Capital Market Live on Channels Television. I'm Ladi Williams. Today, we're going to be reviewing the first half of 2026. It's winding down. At this point, we just have a few trading days left. We're going to be looking at the good, the bad, the ugly, and what to expect in the second half of 2026. But first, let's take a look at how some of the global bourses we track, how they performed on Friday. We see for European markets, they ended the week on a weaker note as investor sentiment it turned cautious across the region. Major bourses closed firmly in negative territory, with Germany's DAX leading losses, while stocks in Italy, France, and the United Kingdom, they also retreated, dragging the pan-European stock 600 lower at the close of trading. So we'll see the FTSE 100 there down 0.21%, the DAX 1.29% lower, the CAC 40 in France 0.55% lower at 8,384 points. Let's flip over to Asian markets now. They suffered steep losses as a broad-based technology sell-off that rattled investor sentiment across the region. South Korean stocks, they bore the brunt of the downturn, with both the Kospi and Kosdaq posting sharp declines. While Japan's benchmark Nikkei also tumbled more than 4% on the scoring. Growing concerns over the outlook for the tech sector there. We see that the sell-off there impacting most of those tech stocks, global technology sector there under a lot of pressure. Let's flip over now to U.S. markets. Now, we see Wall Street ended the week on a cautious note as investors, they continue to pull back from major technology stocks in favor of more defensive stocks. The Nasdaq recorded its fifth straight day of losses, weighing on the broader market, while the S&P 500 also edged lower. However, the Dow Jones bucked the trend, posting weekly gains as investors sought refuge in more resilient blue chip stocks. So that's how most of the markets we tracked look today. That's globally, and we also see the likes of digital assets like Bitcoin also not doing well this week. All right, let's bring it home now. As Nigeria crosses the halfway mark of 2026, we're almost there at this point. Attention is turning to how the economy has fared so far, from easing inflationary pressures and GDP growth trends to the remarkable rally in the stock market. We take stock of the country's economic performance in the first half of the year and assess what it could mean for businesses, investors, policymakers in the months ahead. Joining me for this conversation now, we have Professor Uche Uwaleke, Director, Institute of Capital Market Studies, Nasarawa State University, and President, Capital Market Academics of Nigeria. Good to have you in the show, sir. I'm sure our viewers will be wondering, he's not in Abuja. He's not in the Abuja studio.
Thank you.
He's right here in Lagos.
In Lagos live, yeah, thank you.
With us. Thank you so much.
My pleasure for inviting me.
How's Lagos treating you so far?
Pardon?
How's Lagos?
Lagos is fine. Actually, came for the investiture ceremony of the 14th president of the CIS, the first female president of the CIS, Dr. Fiona Ahimia. Investiture took place yesterday, so I'm still around.
Nice. So we're seeing females now taking the lead in
absolutely
big institutions.
Absolutely.
That's quite incredible.
Yeah.
And when people come from Abuja, they always say, Lagos, there's just too much, there's just too much going on, in Lagos.
Absolutely.
And the peace in Abuja.
Exactly. I can't wait to run back tomorrow.
I know, right? All right, let's take stock now.
Yeah.
Let's imagine this was a match, a World Cup match, the first half. It started off kind of good.
Yeah.
Then moving in, see from March, then we started to feel the Ides of March.
That's well,
somehow,
yes. Yeah.
So how's it been, for you? Who's winning?
Well, I think we are winning. Nigeria is winning.
Right.
Yes. However you look at it, I think I would say performance has been, above average, in the sense that if you again look at where we are coming from. Let's even start from at the macro level. You saw GDP come in first quarter of 2026, 3.89% year on year. If you compare that what we had 3.13, 2025, of course that's an improvement. Although we also find that that growth rate is still fragile in the sense that it's still being powered by the services sector, contributing close to 58% to GDP. And if you have an economy where the services sector continues to power growth, in my view, that's not very sustainable for a developing economy that needs to pull manufacturing, pull agri, up. But the good news is that the last GDP report has also shown a rebound in the performance of the agri and manufacturing, sector. Now you take the case of inflation, for example. Again, we saw what happened after inflation came down to as low as 15 points, relatively 0.6% in February. But we saw the reversal in March, and since then it has been upward trend. No thanks to the Middle East crisis. It was the Middle East crisis that triggered the inflation we had in March, April, and May, such that today, the last data from the National Bureau of Statistics, inflation rate, came in at 15.93%. So inflation rate remains elevated and is being driven by, we all know, energy prices in particular, of course, transport costs, pass-through effects from exchange rates, and so on. And particularly made worse by the insecurity that we have, that is making food inflation remain stubborn. Okay. Now, if you look at the external sector, again, we can see some improvements there. That was why, in fact, when I said above average, I was actually looking at that sector where we recorded trade surplus, and we've also seen inflows, capital inflows. First quarter 2026, capital importation was over $10 billion, you recall. Although there's a challenge there because it was more of portfolio inflows.
Yeah, hot money,
95% came in by way of foreign portfolio investment. But we've seen, as a result of the confidence that has returned in the economy now, thanks to the CBN reforms, we've seen accretion to reserves. Today, we hear reserves are in excess of $51 billion, enough to finance over 10 months of imports. And if you look at where we're coming from, in 2023, for example, net external reserves was less than $4 billion. Today, net external reserves is in excess of $34 billion using the CBN data, and gross is as high as $51 billion. So again, from that point of view, you can say the economy has done well in the last 6 months.
But Prof,
at the macro level,
sorry to butt in there, because today there's so much to cover when it comes to the economy. Yeah. But I want to draw your attention to the inflation trend.
I see.
Right here on the board, we see for January, started off 15.10%, February 15.06%. But you did mention, the spike
in March.
From March, 15.38%, April 2026, 15.69%, then the latest one, 15.9%.
You see?
So looking at this trend so far, we're still in that 15% region.
Yes.
What does that tell us? Is that a win? Still remaining at 15?
Yes.
Somewhat, is it?
Yes. No, of course it's elevated, it's high. And that's also partly why the central bank is reluctant to even reduce the MPR. Remember the last meeting, they cited this as one of the reasons why they were not, they didn't reduce. So they still kept it at 26.5% MPR. It's because of this elevated inflation. And particularly so when you look at the fact that food inflation, the food component is as high as 17%. Okay, so that's where the pressure is. But again, when you look at it objectively, you'll also realize that the factors that are driving this, some of them are exogenous, external to us. I cited the Middle East crisis. Rising energy prices, what did it translate to here? High, fuel pump price. So again,
even though the prices have dropped so much, fuel prices are not dropping as fast.
They are sticky, they're usually sticky,
right.
coming downwards. So I wouldn't say it's a win. Price stability has not been secured, effectively the way it ought to. Otherwise, the central bank, in fact, the expectation in February was that the central bank was going to ease rates going forward, following the 11 months of this inflation we had. But as a result of this, the central bank, had a different idea about how to go about it. So I think that going forward, the downside risks are there. But before we even come to going forward, I was mentioning the external sector. I just finished with the external sector. And monetary policy, we can also see how the central bank, the last 6 months, has continued to tighten. Tighten in the sense that they have not really reduced. It was in February, recall, that they reduced it just by 50 basis points, from 27% to 26.5%. And it has remained 26.5%, since then. Now, if you look at what has happened, in my view, they have also rubbed off positively on the capital market, on the stock market in particular, such that today we are talking about year-to-date return of 49%.
Yeah, we've lost the 50% level.
Yes, of course. We lost that last month. A lot of profit taking took place, recently,
right?
And that's why the thing came down to 49%. And if you compare, but even at 49%, if you compare us with, say, the other frontier economies, emerging economies, if you look at the Morgan Stanley Capital Index, for example, for emerging markets, which is usually the primary comparator, even though Nigeria is still a frontier market, you find that the average return there year to date is 14%. Meanwhile, we are doing 49%. Although some people will tell you that those comparisons, of course, those ones are dollar denominated. But what is important is that our returns usually, have proved, higher, and that again speaks to the fact that more confidence has returned, more or less, and we now have more foreign investors playing, in the market because they see opportunities, and that is why they're coming. And that also, of course, also means that because the returns are high, they're also prepared to take on the risks that are associated with high returns.
All right. So looking at the stock market performance so far, I think we started off the year in 90 trillion level. Then flipped over to 150 trillion, over 150 trillion. But
yeah,
I think we did lose that level.
At some points, it touched 160 trillion.
160 trillion.
So now it's around 150 trillion.
So definitely starting off the year, January was great.
Yes.
For the stock market. February, yes, good. March, not as great. Then we now had April. I think that was a standout month.
Exactly. And then June we saw profit taking.
Yes. I'm sure investors right now would be, I'm sure a lot of them might be panicking. Some of them that are not so experienced.
But the consequential factor that drove the market in the last 6 months, I would say, was the banking sector recapitalization. That was the major thing that drove the market because, of course, the investors, were expecting that when banks able to raise the money, the returns ultimately will be better. And remember too, it triggered a lot of public offers. It triggered rights issues, so that turbocharged the market. And then we also had that foreign investors contributing as much as 27%. Domestic investors contributed 73% of the money that the banks raised. So we saw active participation by foreign investors, by domestic investors, particularly the institutional investors, the pension funds, for example, and then high net worth individuals, that the ones that dominated the market, all through this, all through the period. So banking sector representation, was a major factor. Another factor too, of course, corporate earnings of many of them reported a strong earnings, and that also helped, to push up, their prices. And on the part of foreign investors, you can also talk about currency repricing. The fact that exchange rate was still high, made many of them see our stocks as cheap. Okay, so they could also come to take up our stocks.
So it's quite interesting. Yes. Regardless, we see most of our stock prices there still below $1.
Exactly.
At this point, looking at the exchange rate.
On the part of the foreign investor, is pretty cheap. There's also the inflation hedge factor. There's a number of investors to see stocks as securities where they can get and then hedge inflation. All right. So the high rate of inflation that we have is also encouraging people to invest, in stocks. And then the cheap valuations element too. I wouldn't discount that, because if you look at our stocks, the NGS was trading at a deep discount really compared to other markets. The PE ratio before now had been between 6 times, 7 times, whereas in some other markets you have PE ratios of as high as 12 times. So when you have low PE ratios, it tells you that many of the stocks there, based on their fundamentals, are undervalued. So foreign investors, also look at those metrics, and then
intelligent investors look at most of those metrics. Exactly. We have a lot to unpack Prof, but we'll take a quick break right now. When we come back, we'll find out how to situate your portfolios in the second half of 2026. That's a moment. Just stay with us. Welcome back. We're still reviewing the first half of 2026. What's played out so far in the economy and what to expect for the capital market. I still have with me Professor Uche Uwaleke right here in our Lagos studio. Prof, definitely it's been quite the first half, so far. And, I'm sure investors will be wondering, at this point, what's the play? I'm imagining you're the coach right now.
Yeah.
Who are you subbing at this point going into the second half?
Yes. I have this advice for investors, which I coined. I coined an acronym, DHL. DHL approach is a time-honored advice. At all times, you can win with it. It's a formula you can win with. And that DHL, stands for, is my acronym. Yes, DHL, the D there stands for diversification. Yes, the investors, should always aim to diversify their investment. So of course you don't put all your eggs in one basket. That's what it means. So I expect that, of course, in the next half of 2026, following recapitalization, despite the new regulations we are now getting now from central bank asking banks to holdcos, for example, to make sure they have 20% additional capital. If in addition to the aggregate of the capital of their subsidiaries, that will also trigger a new round of issues, because those holdcos are also going to meet up with their requirements. So I see, that also affecting the market. So I see interest in the banking stocks. I also see interest in industrial stocks. Government policy and efforts by the government to implement capital projects would of course rub off positively on industrial stocks, cement companies in particular, the likes of Dangote, Boa Cement. Next 6 months will be favorable. The oil and gas, yes, oil and gas, particularly the upstream, the likes of Aradel, Seplat, and those ones also give you earnings in dollars.
Sir, Prof, it's interesting you mentioned Aradel and Seplat.
Yes.
That rise, that we saw, for both, over 100% rise for Aradel in the first half, of 2026. Seplat is doing about 90-something%.
Yeah, Seplat is now 11,393 naira.
Right.
That's one.
And all of that on the back of rising oil prices.
Oh, yes.
So now we're seeing those oil prices come down. Do we expect textbook here.
Yes, you see, as far as the Middle East crisis, as far as that crisis is concerned, you can't really, predict. You can say today, peace talks, tomorrow.
Yeah, I think we've been getting reports already
exactly.
of some strain.
Exactly. Yes, but that's also why I talked about diversification. Okay, you don't have to focus on that. There are others. Agri stocks, Como and Presco, are also, there, but they're doing well. What is important is that investment, must be based on fundamentals, not emotions. Okay, identify companies that have track record of dividend payments, track record of strong earnings. These are the companies that investors should put their money in. And it's not, of course, it's not just equities. The fixed income market is also there. And as we speak, we know the fixed income market offers a lot of opportunities, particularly with the central bank's approach, monetary policy tightening. You saw the recent issuances, at very high rates. So fixed income will also remain attractive, and particularly now that the government, if you check the 2026 budget, a lot of borrowing components, is there already. The government is going out of its way to now get a loan from the First Abu Dhabi Bank,
right,
of $5 billion.
That loan's getting so many reactions.
Yes, why I'm saying out of its way is that it's not a conventional type of loan.
Right,
it's more like a derivative, and for the first time we are borrowing with collateral. Yes, government usually borrows based on the full faith and credit of the federal government. So we say government securities are risk-free, but this time around, the First Abu Dhabi Bank is saying we don't trust that full faith and give us collateral. And what is that collateral? Government is going to issue local bonds in Naira, and they use that to securitize the loan. And we are even doing over-securitization. We are doing 1.33 percent. So for every dollar we are borrowing, we are going to be returning 1.33, $1.33. So for the $5 billion, the repayment is $6.67 billion. And of course, the repayment is bullet repayment. Right? We are taking the first tranche now. All right. So why am I saying that? I'm saying that because that may likely also increase the interest rate environment, because the Eurobond holders, domestic bond holders, who are not having collateral, may begin to say, why you are giving these people collateral, we don't have collateral, therefore let's increase our own whatever we're asking for. So
which makes the borrowing costs higher.
Yes, may go up. And yes, and so the investors, the borrowing costs, if interest are being driven up, that means of course fixed income yields will be high. So that's also another area that investors should look at. So in diversification, you put money in equities, you also put money in fixed income. So it's not just equities. And even when you're putting money in equities, you try and make sure that it's not concentrated. Okay, I see people, put money in just banking stocks. That's not the way to invest. So you try to diversify your investment such that when something happens in one, you don't shoot yourself on the foot. But the good thing too, if you check what has happened, unlike before, the improvement we saw in the market appears to be broad-based. I mean, the share price increase. Today, all share index, which is the market average, is 49%. You now notice that many of the indices, are also strong in terms of positive return. Banking, for example, is around 40%. Okay, the industrial is 79% year-to-date return. Oil and gas is over 90%. Year-to-date return.
Oil and gas, the winner.
Yeah, oil and gas is the highest. So it's really insurance index that is under the weather. It's below the water, because that one is -6%. So the performance appeared, in my view, to be broad-based, and that is why diversification too will pay anybody investing in the market.
But we're already out of time. But I'm so curious about H&L, because your style is D.
Oh, okay, yes, the acronym DHL.
I'm curious about H&L.
Yeah, D is diversification.
Right.
Yes, H is hedging.
Hedging.
Yes,
right.
you hedge, and try to hedge. One of the ways by which you hedge, I just talked about, you hedge the inflation by also diversification will also help you to hedge. Okay, and these days we have derivatives that can also be used to hedge. And then L there stands for long term. The market is a place where investors need patience, just like Warren Buffett will tell you. Warren Buffett will tell you that market requires, Warren Buffett? Yes, requires patience, requires discipline. It's not a place you go in today and then you want...
I believe he said if you can't hold the asset for 10 years, yes, you shouldn't touch it.
Exactly.
Right.
So, long term, they should have this long term, view, so that even when something is happening, they don't need to panic, to start selling, because capital markets is for long term, and it rewards those who are patient, and it rewards those who are disciplined.
Thank you so much, Prof. You heard it from the Prof here. Mm-hmm. His strategy is DHL, diversify, hedge, and you need to think long term.
Absolutely.
So you can make profit in this second half of 2026.
Yeah.
Thank you so much, Prof. Always great to have you.
My pleasure.
And we'll definitely see you again when you get back to Abuja. Thank you so much, sir. He's the Director, Institute of Capital Market Studies, Nasarawa State University, President, Capital Market Academics of Nigeria. Thank you so much, Prof.
Pleasure.
All right, so that's the show today, and that's the last capital market edition. That's for this first half of 2026. Hope you've got some knowledge here going into the second half, and hope we all make some profit. Thank you for watching Capital Market today. I'm Ladi Williams. Remember, buy low and sell high. Bye-bye.